We got to start on China. Is it getting easier or harder to stay overweight China now?
Well, we're still overweight China, Hong Kong China, but, China is going through a crisis of confidence. There's lack of confidence among private investors, companies to invest, on consumers to spend more, overseas investors to look at that market, despite the fact that the valuations are cheap and that market is underowned. So this crisis of confidence is difficult to overcome with the old-style policy stimulus announcements. And I think the Chinese policymakers also understand that. So, the reason why we're still overweight China are a combination of these reasons. Number one, the under-ownership of the market. The market is cheap, discounting a lot of the negatives that we're seeing right now. And there are a few pockets, like the consumer discretionaries, internet e-commerce being part of that. The SOEs, which have dividend yields of close to 6 to 8%, in some cases even more, and some of the tech hardware companies, which are the policy beneficiaries. There are some of these pockets in that large universe which investors can still play. That said, I take your point, that argument, and that, the courage that's needed to stay overweight China. Obviously, it's kind of raising the bar at this point of time. But I would think that, these are some of the variables that we need to fall in place before it actually plays out.
You mentioned dividend yields. Let me just touch on that. Chinese banks, would you recommend Chinese banks because of the dividend, because of also the exposure to everything, to all bad news right now?
Absolutely. I would recommend them again selectively. This whole argument about China is being constructive but selective. There are Chinese banks which have a relatively lower degree of exposure to the property sector, to developers. Some of them are somewhat, quite fortuitously, the SOE banks. And many of these are actually yielding in the range of 7 to 8% right now.
You mentioned other markets. You've changed a little bit in terms of your conviction in India. You're saying this is a pretty easy sell now to investors? How do you deal with the valuations too?
It is, despite the expensive valuations, it is turning out to be an easy sell. If you look at the foreign fund flows over the past 4 to 5 months, India has been a favorite almost like it has never been before. I can understand why. Because if you look at the large swathes of the Asian investment universe, you have Hong Kong China, which is about 43% of MSCI Asia ex-Japan. You have Korea and Taiwan, which kind of for a while did well because of the AI demand-related euphoria. But it's, again, kind of subsiding right now. So in that context, there are very few pockets that investors can actively look at, and India is clearly one of them, where the economic growth is strong, the goods and services tax collection, the credit growth at 16 to 17%, the kind of investment spike that we are seeing, not just from the government, but also potentially spilling over into private sector. These are all significant tailwinds that you can rarely find elsewhere.
Is that the only market that global investors are willing to touch in Asia?
Is it the cleanest? Is there other cleaner markets out there?
The other market, apart from India, India has obviously taken the bulk of the inflows in recent times. Another market is Indonesia, where we have seen enthusiasm for some of the EV-related materials, nickel in particular. We have seen enthusiasm for the Indonesian banks. They have seen significant earnings.
Why on banks? I'm curious. Why on Indonesian banks? What's the play there?
Well, Indonesia is one market where you have strong demographics and relatively better growth in terms of longer-term economic growth over the next few years. And that's what you need for the banking sector to succeed.